welcome to today's webinar. My name is Ahmed Nazal. I'm an analyst at AB Accelerator. Today we have Juan, the co-founder and CEO of Fligoo. Fligoo is a tech company based in San Francisco and Argentina. They specialize in AI, big data, and machine learning with a focus on behavior analysis and prediction. Today, Juan will be sharing his insights on AI in enterprises and financial services. Juan, thank you very much for joining us today. I will pass it on to you now to kickstart the presentation.
Thank you very much, Ahmad. Can you confirm if you can listen to me properly?
Yes, I can hear you very well. Yeah.
Okay, fantastic. Hello, everyone. Thank you so much for having me here. It's a pleasure to be in contact with all of you. I'm going to share screen to get into the presentation of today. That, as Ahmad said, it's going to be around a little bit about enterprise AI and financial services. We're going to touch a couple of topics there. I'm going to try to share my personal point of view about some of these things, and hopefully you'll get something out of it. Okay, so a little bit about myself. I'm one of the co-founders of Fligoo. Fligoo is a technology company, an enterprise AI and decision science software company, to be more precise. And what we do is we provide SaaS solutions that allow companies to enhance their business and increase revenue by understanding, predicting, and actioning on their customers' behavior. So we typically work with companies with large customer bases that can really leverage AI to monitor their entire large customer base, to see what's going on with each of their customers and develop stronger and better relationships with them on time. Just for context, we have offices in San Francisco, New York, also in Brazil, Argentina, and we are now expanding to Europe. That said, we can serve customers all around the world. In fact, we do have customers pretty much all over the place. And just for context, some of our partners are MasterCard, Broadridge, some of our investors and advisors are people from the companies that you can see below, but that's just for context. One more thing about the company, and what we are trying to be the best at, is the following. There's a space between a company like our bank, for example, and their millions of customers. There's a space between these two parts that's called the relationship between the company and the customer, that usually involves products that the company provides to customers, the growth that the company expects customers to have, communication that the company sends to customers, education, performance, satisfaction, engagement. There's a lot of things that make up the relationship of a company with a customer. Our goal is to become the #1 company at turning everything in the relationship into success and growth. So enhancing satisfaction, enhancing tenure, enhancing growth, and enhancing revenue by using AI to help that happen. So that's where we are trying to focus. That's where we're growing. And that's how we are spearheading our development of products and growth. Now, with that said, enough context for now, enough introductions. We're going to get into the agenda. The agenda today is going to be a little bit, we're going to begin with, as I said before, my personal view of the enterprise AI market status, mostly in financial services, but also I think it applies to other industries. We work with other industries as well, such as wealth management, insurance, fast-moving consumer goods, and a couple. Then we're gonna get into our own approach, like given the context that we are at, how we are approaching our implementation of enterprise AI and making customers successful. We're gonna see that through a case study. And then we're gonna close and get to the takeaways. So let's get going. Something that has helped me personally understand how new technologies go through their life cycle is what Gartner calls the hype cycle for emerging technologies. This graph or this concept basically says that for every new technology that comes out, there is usually an innovation trigger that makes that technology become available. Once the technology becomes available, many people get excited about it. You can see the expectations here, right? So as soon as a technology becomes available, A lot of people get excited. It's a new thing. Hey, we need to get there. We cannot miss this out. Everyone jumps in, starts investing, hires people, and hires vendors, and the expectations start going up. Like, oh, everyone's so excited about it, until it reaches a peak of inflated expectations. There's a peak where things then start going down to the trough of disillusionment. That is like, okay, at this moment, what happens is that typically everyone got on board in the new technology. People started executing. Everyone is like so hyped up until you start seeing the first results, and you start seeing that after 6 months, 12 months, 18 months, things are not going as well as we thought. The promises that we did at the beginning, not all of them have been delivered. Some of them did, but some of them didn't. So yeah, at some point we started getting back to reality. We start like separating the hype from the reality, and we start going down to what people call the trough of disillusionment, because companies have already invested a lot. They put a lot of hopes in it, and yeah, some of them are getting results, but a lot of them not. The media starts covering the bad stories. So yeah, it starts going down and down until some of those initiatives that were successful because they were framed in a proper way, they were like correctly executed, and a couple more things. They are successful. They are covered by the media as well. We start reading about those success stories, success cases, etc. We start going up again to the slope of enlightenment, and that's the cycle for pretty much every new technology, according to Gardner. I more or less agree with this concept. So I started getting interested in this topic in 2017, more or less, and I've been following this curve for AI, machine learning, and technologies that we operate with. And by then, 2017, yeah, more precisely July 2017, Gardner was putting deep learning and machine learning right at the top, right at the peak. It was at this maximum value of inflated expectations. And then, well, after following the tendencies and the trends in the years, if you look at Gardner's graph today, so 2020, the most recent one, they're placing machine learning a little bit more downwards, and then insights engines, a new concept that they have introduced to this graph, they're putting it here, which means that it already went to the trough of disillusionment, and it's starting to go up again. That's what they say. If you ask me, in my experience with customers in the US, Canada, and Latin America mostly, I would say that my opinion is that, yeah, the technologies that we operate with, that is a combination of machine learning and insights engine, we are here. We're here, which means that we have already gone up, we have already gone down, and now we are at the point where things are starting to pick up again. And why is that? Because many of the companies that we've worked with have already been disillusioned, and they have found the way, after trying multiple things, they're starting to find the way to generate business results and start growing again. Another thing that Gardner was saying around 2019 was that through 2022, only 15% of the use cases leveraging AI techniques will be successful. That's something they said at that time. I've been following since then. I think it's pretty accurate for what we are seeing as a company. And that when you take a deeper look at why AI initiatives are being successful or failing, 85% are failing, so let's start there. Research says that there are 4 main reasons that make them unsuccessful. First one is using a driver other than business, which means that many companies are thinking about AI just as a technology initiative with no connection to the business. Second one is talent, which means that companies have a hard time acquiring and attracting good talent, retaining the talent. I mean, data scientists, data engineers, everything related to AI is pretty competitive these days. They're great companies fighting for talent. So there's a struggle in every company to keep that talent focused and retained on the project. Third one is breakdown in communication. So tied to what I said in the beginning, data science versus business. Many companies are not connecting the 2 pieces. They're running separate and parallel. Those things don't get to a good port. The fourth one, I would say, it's overcomplicating projects. So trying to go for the moon from the beginning, so taking 2-3 years to work on this super big initiative that never sees the light because I know it's too complicated. So if you take a look at this and you analyze the reasons, there's nothing around the technology that's making projects fail. It's mostly about execution and management of the initiative to turn it into success. Yeah, okay. So the way that I see it, I'm the COO of the company. I have like one foot on the technology, I have one foot on business. So I always have that two-part view. My point of view is that companies like projects fail in the end of the day because of these reasons, but ultimately because they fail to produce or perceive a return of investment, which is business goals. And this is, for me, the most important thing because typically behind every AI project, there's a person that is signing a check saying, hey, let's invest in this, let's do it. And it's hoping to get a return, an ROI. An ROI is typically measured from a return on the investment that I'm making, the period of time that it takes me to recover that, and the risk that's associated with the initiative. So I believe these are the main things that are making AI initiatives not be successful, but ultimately because they don't get to an ROI. Now, 85% of the projects are going to fail, but there are 15% that will succeed and are actually succeeding with incredible results. That's the beauty of AI. With relatively small investments, you can produce astronomical return, and that's where I'm going to focus the next part of the talk. For this, we're going to use one of our case studies that we operated, a customer of us, a top 10 bank in North America, that hired us to work with them on a couple of things. I'm going to go over it and tell you, give you a glimpse of how we think of it and how we implement AI in enterprise context. So this is a case study with a top 10 bank in North America, where in 90 days, we could produce a lift of 16% in total credit card sales, 44% lift in premium credit card sales, and we're generating about $19 million of additional lifetime value per year for this bank in this region. In this case, the keys to be successful in exceeding the business goals that we had were four things. One, defining the business case. Two, implementing the right technology. Three, using the right execution approach. And four, keep challenging the status quo. And we're going to dive into each of these in the next couple of slides. Let's start with the business case. I think, again, as a COO, as someone that looks after technology and also business, the most important thing to begin with is having a very clear and concrete business case. In this case, it was pretty simple. It doesn't have to be like too complicated. Even more, the simplest, the better. In this case, this was an entire business case. So we had a situation where we needed to increase credit card sales in a certain region. The variables that we could play with were like focusing on 4 credit cards through 4 sales channels that the bank was using. The stakeholders involved were the credit cards people, risk people, marketing, data science people from the bank and channels. The way we would track performance was just looking at lift in sales conversion rates. So no vanity metrics here. And the goal that we had was to increase between 5 and 10% these conversion rates and sales, because that we knew would deliver X amount of dollars in return. And as a side note, like internally at Fligoo, we try to work on opportunities where the expected return of the business case for the customer is at least 5 times what they're going to be paying for the solution. So we think in those terms as well. Second, a key to the success of this initiative was implementing the right technology. And in this case, they were using one of the solutions of our enterprise AI suite, which is called Fligoo Sharp AI Sales. Fligoo Sharp AI Sales is a product that uses AI to analyze customers' behavior using thousands of variables of the bank's customers' behavior to understand what product does each of the customers of the bank need, and then two, it puts those exact products in front of them at the right moment through the right channel and through using a right sales pitch. Let me show you how this looks like with an example of a screen of an agent that makes sales at a bank. This is Lisa Miller. These are the products that we are recommending the bank to offer to her. These are the probability of purchase associated with each of the products. These are the reasons why we are recommending the product to this person. So a certain level of off-country transactions, a checking account balance, a certain credit score, etc. This is the best channel to contact her. Day and time to make the call and get a positive response. And even a suggested sales pitch that we are making based on the profile of the person and the reasons why the product is being assigned to that to her. And in this case, it was the right technology because our technology is designed to maximize the ROI of this particular use case at every stage. You're going to see in the market there are like a lot of different technologies and platforms and solutions that you can use to make predictions of behavior and try to pursue your business cases. Not all of them are useful for all of the cases. It really depends, on my opinion, on the teams that you have internally, who is owning the project, the scope that you want to give it. It's not the same to just go after credit cards, increasing credit card sales, and to increase sales of all your retail banking products, or also include insurance products, or also include wealth management products. I mean, there's a lot of things that you can you have to take into account whenever you make a decision on to go for technology that's more specific, more broad, more oriented to the business person, or more oriented to the tech team of the bank. Well, in this case, it was the right fit, and I'm gonna show you a little bit why. Our technology in the back end has these four main stages. First thing it does is it ingests customer data from multiple sources that banks already have. What we do with these sources is we get access to these data sources, and we put them all together in one place, usually a data lake that the bank already has, or one that we can generate, because we're operating all the time inside the bank's environment. So we're working on-premise or on the cloud of the bank, but we're never taking data to our own servers. So we are avoiding a lot of friction there. We're reducing time to success. So first step is ingesting customer data from multiple sources, putting everything together in one data lake. Step two is, give me a second here. Okay, yeah. A quick note about data that we typically use is mostly data that banks already have. So demographic information about their customers, risk information about their customers, bureau's information, historical transaction, how have they responded to past marketing campaigns, product acquisitions, et cetera, et cetera. Step two is running and processing all this data that we have in data lake through Fligoo API. There is an AI framework that will process all this information through multiple different approaches in parallel at the same time, trying to identify the optimal approaches for predicting the sales opportunities or whatever we're trying to predict. And what we are doing here by running multiple approaches at the same time, dividing the customers and executing multiple approaches at the same time, is we are reducing time because we're trying many things at the same time. We're also de-risking the operation because we're trying, I don't know, 10, 12 different approaches at the same time and just selecting the top 2, 3 that perform the best. So we're maximizing the conversion rate, the return at the same time. And we're de-risking it because by trying multiple things at the same time, we are guaranteeing that we're going to work with the most successful things in the end of the process. And this, like, yeah, again, tying it back to the return on investment equation, it's enhancing the above number or the below number of the equation. And we have that concept in mind all the time. So stage two is running all the data from customers through the AI framework, making all the predictions for each of the customers. Stage 3 is turning those predictions into a recommendation for each of the customers. So out of the 10, 12 predictions that we might make for each customer, we just select the optimal ones and say for each customer, what's the right product, the right timing, the right channel, and the right sales pitch that the bank should use in order to put that product in front of them. And stage 4 is if we want to generate an impact on the business, we need to somehow deliver those recommendations and put them in front of the customer. Otherwise, it's just innovation theater. So stage 4 is connecting these recommendations with an API and integrating them to the existing systems of the bank so that the bank can actually put the product in front of the customer through a CRM, through the call centers, through the mail or email or the web or the app or any channels that you are currently using to generate your sales outreach. Now, the third part is the execution approach. What do we do in this case? What's what we typically do? We really care about the execution, specifically and most importantly than everything, the first 90 days. The way that we try to de-risk the operation and confirm that we are on the right path fast is running 90-day pilots, delivering a quick win that tells us that it's worth to make the big investment for the future, for the longer term. And we think of it in the following days. We try in the following way. We try to set a goal to implement and test in 90 days. And for that, we assign a team of around 3, 4, or 5 people, depending on the case. Usually a project manager that brings the business mindset to the project, a couple of data scientists and data engineers that are going to take care of everything so that the bank's people don't need to spend a lot of time and get distracted in trying a new initiative that might be successful or not. So we assign a team of 3, 4, 5 people, and we work side by side with the bank through 5 stages. First one, defining and refining the business case that we're going to go after, making it as clear as possible, defining what's going to be the most important things, the KPIs, who are going to be the key stakeholders, how we're going to measure success, et cetera, et cetera, et cetera. Stage 2 is data assessment and preparation phase. This means our team getting under the hood of the data warehouses of the bank and like really taking a look and understanding what pieces of data could we use in order to pursue the business case that we're going after. It also entails like analyzing the data, preparing it, cleansing it, normalizing it, like preparing it for AI predictions. Stage 4 is customizing the software for the specific use case. Stage 4 is connecting with APIs with all the front lines so that we can then try the recommendations with actual customers. And stage 5 is a stage of testing and production. So actually taking the experiment to the market, to the street, to the real customers, and measuring the impact that we could have in the initiative. What I think is valuable about doing this is that it's a very hands-on approach. It's the one that we tend to select as opposed to other solutions that are more like self-serve solutions. And the reason why I think it's more appropriate to do it this way is because when you like provide a solution that's self-serve in the context of AI, there are many things that you can do while executing that might like jeopardize the success. One of them being the most important is that the team that might take care of the initiative might be doing that for the first time. And it's very hard to do that right the first time. That's why we choose to provide a team that has done this many times successfully with many customers in different industries, because it's people that already know how to manage the entire execution, manage the communication, they know where to look at, they know where to deliver the results. I don't know, they know the entire thing that you need to do in order to make one of these initiatives successful. After the 90 days of implementation and after the test is successful, part of our approach as well is to keep a team of engineers assigned to each of the accounts of our customers. Again, on the long run, our solution is not a self-serve solution, it's a managed solution where we are providing experts on the topic that have done this many times. We're going to take care of everything that the AI models behind the solution will need in order to be optimal at every point in time. Typically, banks will need to tweak their models for new business constraints or new risk requirements or new marketing rules that you might have. Or in the future, you might want to add new business lines like insurance or loans or other things. You might want to add new territories that the AI models haven't seen before. So you need to incorporate that into the models to make accurate predictions. Same with new products, same with new channels you want to use. All those things require very deep AI knowledge about the models and how these things work. And we are trying to support our customers by providing a team of experts to take care of that as well. So that's what we did with the bank. It's typically what we do with our other customers in the same industry and other industries as well. In this case, after those 90 days that it took us to implement the solution and get to the results that we just saw, of course, this relationship has evolved through time. We are currently having a lift of about 20% in credit card sales. We are generating about $23 million of additional lifetime value per year for this bank. And the way that this bank is thinking about us is that they have a cost of 0.12 cents for each dollar that we are generating for them. That's the way we think of it. They think of it. And I think it's pretty accurate. We're also trying new business cases, and we're currently handling 80% of the bank's leads for credit cards. And the reason why we're not handling 100% of them is because they are already challenging our own models. I think this is a key. So I think it's very important to never settle for whatever metrics you're getting. You can always keep evolving. It's going to change. The market's going to change. The model is going to change. Your customer is going to change. You need to keep defying and challenging your own assumptions. So I think it's pretty healthy to always keep some part of your strategy challenging your current status quo. Just a quick time sheet here. Okay, perfect. Two more things I wanted to show very quickly about this case. Apart from expanding into other line of products, we're also helping them optimize channel distribution for their sales efforts, where we are identifying what's the right channel to use for each customer and each of the products they are trying to sell. We're optimizing their efforts regarding communications through email, call centers, direct mail, and branches. Some of their products are better sold through a call center. Some of their products are better sold by sending a direct mail, a physical envelope sent to the address. They have different costs. They have different impact. We have to optimize that equation, and we're having very good results there. And another thing, just to give you an understanding of the level of depth that we can get with customers and that we like to get with, is that, we are also working specifically on an area of the bank, which is the call center, where we are providing the insights that I showed you before to call center agents and comparing the performance of the agents that are using Fligoo against agents that are not using Fligoo to make sales. The results are that they're getting about 300% lift in conversion rates for outbound efforts, which is incredible, and they're all very happy. Last thing I wanted to show you is another example, more oriented to the wealth management industry, that will provide an overview of how we think of it in the bigger picture. Okay, so this is a demo for a wealth management context, but it's the same to retail banking, it's the same in insurance, it's the same in many other industries. What I'm trying to show you here is how we are thinking about helping a company with a large customer base be successful at all fronts of the relationship, what I showed you in the very first slide. So let's take as an example, Julia Humphrey. This is a wealth management customer of a bank in the US. This person has like $60,000 in total assets. This bank is managing like $18,000 of their assets. They have a certain level of available cash. There's a market value opportunity of a certain number. And we are tracking three main indicators here. The loyalty that this person has for the firm. So how likely this person is to leave the firm or stay with the firm in the next 3, 6, or 9 months. We are predicting the level of satisfaction of this person. And we are also predicting what's the performance potential of this investor with this particular firm. All these indicators are very relevant for wealth management. There are others for retail, there are others for insurance. It's all customized. But what I want to show you very quickly here is the different things that we are analyzing for each of them and providing banks with. If you get here, we can see which are the products that we are recommending the bank to offer to Julia Humphrey. Based on all this data and the analysis that we're making, we are recommending these agents or advisors to offer, let me make a little zoom here, a goal-based financial plan as a first product, life insurance as the second one, IRA funding as the third one. If we click on the first one, we can see a brief description of the product, the reasons why we are recommending to make this offer. We can even send an email with a suggested sales pitch that's generated based on the profile of the person and the product that we are offering. If we go here, we can also see wealth management is an industry where there's a lot of education to be done with your customers. You have to tell them stuff to be prepared for the next market swing. You have to prepare them for the next life event that they may have. I know you have to grow them. You have to educate them because it's really important for their financial health. So we are doing in this section of recommended content is analyzing the different pieces of content that the bank can have to distribute to their investors. And we're telling them exactly which pieces of content to send to each of them based on their profile, their life cycle, the moment in life that they're into, the same way that we are doing it with products. Again, you can send these articles really easy from here because we're trying to again, put the things that we come up with in the predictions. We need to get those into the hands of the customers. Otherwise, there's no point of doing innovation theater. Just last thing here to close the idea, when we go to speak about loyalty, we're calculating how likely this customer is to leave the firm, close the account. In these cases, withdrawing the funds from the bank. In this particular case, we're predicting 9 out of 10 account closures with more than 90 days of anticipation. We are recommending the bank different actions that they have to take in order to keep these customers engaged for a longer period of time. So that's when we think about customers. The other way to think of it is entering the platform through a solutions perspective or through a product perspective. So if I'm a salesperson inside a bank, I'm in charge of increasing credit card sales or increasing, personal loans or whatever it is. I can enter the platform through this section. And here I will see a list of all the products that the bank has. And the system will tell me automatically how many of the people that I manage has a very high likelihood of acquiring each of the products that we are offering. Let's say I need to increase the sales or the provision of IRA funding. I'm going to click here. I'm going to immediately see who are the people, the investors, the customers that are more willing to acquire this product because we've been analyzing them for the past 2 or 3 years and understand their behavior. And I'll see for each of them what's the probability of purchase of this product, and I can send it right away. Okay, I can send it right away to all of them with a personalized message, and therefore start increasing sales way faster. Okay, just making a quick time check here. I think that covers most of what I wanted to show you of our latest release of the product. Hopefully give you an idea. Of course, we can keep chatting offline after this, but wanted to also leave some room for Q&A. So I just wanted to close with the key takeaways, in my opinion. If I have to tell anyone what I would consider as the most important factors, they would be thinking of AI in terms of business and not only in technology. Using the right technology, depending on your data availability, your teams, your purposes, and the scope of the project. Focusing 50%, if not more, of your efforts on the execution of the thing, not just on choosing a technology. and fourth, keep challenging the status quo. That's all. Thank you very much.
Thank you, Juan, for this great presentation. We'll be moving on to the Q&A segment. So the first question we have is, financial institution data is usually unstructured and lives in silos. How do you usually tackle such a challenge?
That's a great question, and it's true 100% of the time. So Fligoo Sharp AI is a very complex solution that has a lot of different components. We have an entire set of components that are specifically focused on putting data together, cleaning it, normalizing it, and preparing it in a very fast way. We spoke about getting stuff done in 90 days, of course, like not for the entire bank, but for the first part that we choose to start with. These components allow us to get to very good quality data in about halfway the 90 days. So in 45 days, we typically already have very good things. And that's a result not only of the solutions that we have for processing and preparing data, but also the fact that we assign a team of data engineers and data scientists that have done this many times. So they typically know like who to speak with, how to handle the different challenges that we're going to have, how to get the buy-in from the tech side of the bank, which is always something that we also have to look after. So I would say it's the way that we address it is a combination of the product that we have to doing that, but most importantly, the people that we assign to take care of the initiative, who have done it many times.
Another question that we have is, so what type of metrics are usually taken into consideration when measuring consumers' loyalty, satisfaction, and performance?
Can you repeat the question? Sorry, Ahmed.
So what type of metrics are taken into consideration when measuring consumers' loyalty, satisfaction, and performance?
What type of metrics? Okay, let's see. I don't know if you are asking about like how do we measure it or which are the variables that are making us predict loyalty. I'm gonna touch the two just in case. So if the question was regarding how do we measure or what's the logic for us to come up with a 92% loyalty score, I'm gonna give you an example of how we calculate that one specifically. In reality, what we are calculating in that case is the likelihood of a customer to leave the firm, and then we're turning it to a positive message called loyalty. But actually, we're calculating how likely this person, each of the persons, is to like withdraw the funds or close the account or whatever we define the churn event to be. For that, we're going to see historically what was the behavior of people at the before and at the moment of closing an account. Let's say we're going to identify the profile, the general profile of the people that close these accounts, and they might be different personas there or different profiles. And then what we're going to do is compare each of the customers of the bank. We're going to compare that profile with the profile of people that's canceling their account. We're going to calculate the probability of similitude or assimilation, right? With that, we can calculate how likely this person is to behave with this person, that is the person that closes accounts. And that's how we come up with the score. Then to calculate loyalty, it's like 1 minus that likelihood. So that's for that part of the question. Now going to the other part of the question of how do we know that that's going to happen? Well, again, we are analyzing behavior of everyone that closed an account in the past. We're analyzing, 250, 500, 750 variables that are relevant for that specific thing. And we're making conclusions out of that. If we're speaking about wealth management, we might be looking to funds in to the account, funds out, fees that advisors are charged their customers, how their portfolio is performing. I mean, there are a lot of variables for that context. If we're speaking about retail banking, for example, we might be like tracking other stuff like how are they using their debit cards, their credit cards, how many times a day do they enter the app, interactions that they have there. It really depends on what we would like to do, what we would like to look at, which is basically everything, and what it's available according to the regulations of the country, the industry, and the policies of the bank. Hopefully that helps answer the question.
Thank you, Juan. Another question we have is, in your perspective, what type of alternative data should banks leverage to better understand their customers?
Good question. What I can say to start answering that question is that everyone thinks of social networks as the first thing. And we have a long story with social networks. We started the company as a company that used to analyze Facebook information back in the day when it was pretty open. And I would say that analyzing social network information today is pretty complex because it's very regulated. It's very hard to get consent from customers for you to use their social networks data. And that's true for Facebook, for Instagram, and for those kind of networks. Twitter is a little bit more open. You can read and you can analyze stuff there, but it's very hard to connect stuff on Twitter to your customers. I mean, it's very hard to make the connection of who's speaking and if that person is your customer or not. So I would say that that's not something that we are looking at very proactively. Other things that have helped us in the past is analyzing, enriching the data that the bank has with environmental data. For example, if you're speaking about the US and we are analyzing people that are going to leave the bank or what should I sell to a certain customer, it has been useful for us to look at demographical information about, I don't know, how COVID was spreading in different states in the US and neighborhoods and what was the impact of unemployment in different sections. That's all public data that the US government publishes. And you can incorporate that and then say, okay, for people that surround this specific branch in Arizona, Arizona is having a very hard time in COVID. There are very high unemployment rates, and that will affect somehow the people that is tied and connected to that branch that's in downtown Arizona. So that has been useful for us in the past. Yeah.
Thank you. And how do you implement a data-driven culture within an organization?
Good question. I would say my take, and you're going to find a lot of different opinions on this. My take is the CEO has to say, hey guys, we are going to be a data-driven organization. It cannot be anything below that guy or that woman, sorry, because it has to be right from the top. That's number one. Number two, for me, the best approach is to recognize that, our bank or any other banks, there are banks that need to start operating with technology to do their business better. But I think it's a mistake to consider that you can be the best bank in the world and be the greatest technology company in the world and be the best at predicting everything that will come to your mind in the world. I think that the best approach is to recognize that you're an incredible bank and you want to be even better at that. And I think it's very good to make a team of experts and really good people that can manage data-driven initiatives, but not necessarily execute all of them. If I was in the position of the CEO of a bank, I would create an incredible department that could choose the best providers for each of the use cases that I will pursue. A team that can really be good at discriminating vendors, for example, and then being able to choose the best at cybersecurity, the best at data analytics, the best at AI for fraud detection, the best at AI for sales. I think that's a much better approach than trying to make everything internally and then figuring out that it's impossible because no one can do that. That's why we that live and breathe this every day we have chosen to focus on sales, churn, and a couple more things related to customers, but we're not predicting everything because it's very hard. So I think those two things are pretty important. Yeah.
Thank you. And another question that we have is, how do you benefit from your models across geographies? Do you recycle models or some of your models?
That's a good question. I think the learning from one customer to the other, and especially from one geography to the other, it's relative. There are things that we can bring from one to the other, and there are things that not. Fortunately, our solution is built in a way where it accumulates hypotheses. Every time we're going to implement our solution to, I don't know, help a US bank increase sales of credit cards, and then we do it to a European bank, for example, we're going to bring all the hypotheses that we built and confirmed for the US bank. We're going to try to apply them to the European case. What's going to happen typically is that some of them are going to be relevant, some not, and we're going to add additional ones to Europe. Then when we go to, I don't know, to the Middle East and try to implement there, we're going to bring the US hypotheses, the European hypotheses, and we're going to try them there. 50% are going to work, 50% not, and we're going to add new ones there. So it really accumulates hypotheses, but then half of them are useful, half of them not.
Perfect, thank you. Another question from our audience is, can you provide briefly an AI business case that you've been involved in related to a bank's operational efficiency with regards to payments or loans?
Yeah, we are focused mostly on commercial, like on sales or revenue and making banks successfully in that regard. So our experience with optimizing procedures, it's always about reducing, increasing conversion rates of sales, and I don't know, like getting to a certain level of sales faster, or reducing the amount of necessary contacts in order to produce a sale. We're not optimizing, like everything. They're always there. And one thing that comes to my mind is what I showed you before about optimizing the call center workflow and the costs and the conversion rates associated with it. That's an interesting case from an operations perspective, because in that case, like just to give you an example, this bank was trying to sell credit cards through email, direct mail, so sending an envelope to your house, call center, and branches. Okay, an email has 0 cost to send. You can send an email to everyone. A call center call has a $5 cost per call, or $8, for example. A physical mail to someone's house addresses has a $50 cost, right? So when you're optimizing all that equation, or what we did in this case, it's completely translatable to all other cases, is we reduced the amount of envelopes that they are sending to people's addresses by 50%. We got an increase in conversion rates. We got an increase in sales, even if we reduce the budget for that 50%, because we're just sending envelopes to people that need envelopes, right? Probably, like, I don't know, I don't want to say the typical older people will react better to a physical envelope than to a push notification, because that's true, but it's more complex than that. In that case, we reduced 50% budget allocation for physical envelopes. We still got a lift in response, and we did it like a similar thing to the call center. Remember I showed you that agents using Fligoo had a 5% conversion rate, and agents not using Fligoo had a 1.3% conversion rate. By doing that, we're saving a lot of calls, unnecessary calls. In the end of the day, that means less people needed to achieve the same level of sales, or with the same people achieving much bigger level of sales in a shorter period of time. That's the way that we think of efficiencies. It's always related to accelerating sales and reducing costs in that sense.
So one interesting question we have is how should internal data teams work with companies like you? Do they compete or complement each other?
I think, that's a great question, because I know there's very talented people, internal teams of banks and every other company. And I think that they have an advantage that outside vendors don't have, that is they know their organization in a much better way than we can. They probably know their industry, their territory, their customers in a much better way than we do. So I think the best thing that the company can do with the internal tech team is to complement them. I mean, one of two choices: either complement and work very closely with the vendor, so then they understand what's going on, to be able to explain to other people, so they understand what's going on, to be able to give responses to the rest of their team, and to understand what's going on in order to provide insights and guidance that help the project be more successful. That's one way of complementing it. And the other one, which I think is cool as well, is productively competing as well. I mean, not considering, hey, I'm gonna beat you and I'm gonna I know, leave you on the ground. But competing just for the sake of success. I mean, when internal tech teams can think of this as a business objective, they shouldn't care much if they're the ones writing the code of the algorithm that produced the increase in sales, or if not. I think that they should be thinking of, hey, I'm responsible of using technology to increase the performance of my bank. I'm going to make sure to do that, regardless if it's my own code or this other person's code. I don't care. I'm above that. I'm above that ego. I just want to deliver the results. That's what I would do.
Thank you. One last question we have is, if you want to incorporate AI in your business, what are the best practices for this?
If you want to co-create, you said?
Sorry, so how do you incorporate AI in a business, and what are usually the best practices for this to successfully happen?
Let's see. I think I will repeat a couple of things that I said before. I think there has to be a buy-in from the CEO. I think there has to be education about AI. And there are two types of education. There's the, the academic and the research and development education, where's the research going? What's the most cutting edge things, the most interesting things, cool things to see? I don't know, but not necessarily, those things are not necessarily applicable to the business yet. So it's good to go that path, to know where the things are going, but then you need the other type of education, which is understand really what's really working on today, what's really generating results and impact today, even if it's not as glamorous as this, what the MIT labs are discovering and publishing on the latest Nature publication, right? You have to be able to manage both things, the cool stuff on the magazines and the news, and also what's working on the day-to-day life. Because sometimes for specific cases, you better use a linear regression than a super complex neural network that has any impact.
Perfect. I mean, these are all our questions today. Thank you very much, Juan, for joining us and for sharing your insights and for this interesting discussion. And for attendees, thank you very much for taking the time to attend. And yes, thanks a lot for your time, Juan.
Thank you very much, Ahmad. Goodbye.
Have a nice day. Bye-bye.
Bye-bye to everyone. Bye.